So Trump's tariffs are hitting headlines all around the world, and you might be worrying if you're currently investing in the S&P 500 like I am. So I want to talk about, should we panic or should we profit actually from investing in the S&P 500 right now? I'm going to go through the different age groups, so whether you're in your 20s or in your 60s, about the dangers of being in the S&P 500 right now. So firstly, what are tariffs anyway? So tariffs are taxes on imports. So that means any good that is coming into the USA is going to have an extra cost to it, which means an extra cost for that company. So for example, if you're in America and you just want to buy a Scottish whiskey, before it may have been a certain price and now it might be higher because the company had to pass on that price to cover these tariff costs. Now that's not a given. Some of these companies may actually swallow the cost of the tariffs, but some may actually affect the consumer in America. And because of these trade tensions, this may cause swings in the market, which is what you're seeing now when you look at an S&P 500 chart. It's very red. And this can affect all types of companies, from manufacturing and tech like your Apple phone, all the way to agriculture. But the very first thing I want to talk about is not to get too caught up in the news headlines. If you look at this S&P 500, yeah, it's very red over the last few days, but let's zoom out for a second. Let's reverse back to a 5-year view from when the pandemic hit. There was, of course, a massive drop there in the S&P 500 stock market. Yes, it has dropped, but nowhere near as that massive drop in 2020. So it's really important here not to lead with your emotions. You may be hearing headlines from everywhere, from everybody from your neighbor to Sky News on TV, about how tragic these tariffs are. And yes, they are incredibly crap for a lot of countries because they're so high, but you shouldn't lead with your emotions and you shouldn't lead with fear. A lot of people might be taking money out of their S&P 500 because they see that red line over the last few days. But of course, when you step back and look at the bigger picture, it's just a momentary blip in that market. The way I like to think about S&P 500 or any index fund is that we're going to do it for the long term. So I'm age 34, okay, and I'm not going to touch my investments in my S&P 500 until I'm about probably 55 or 60, right? So I know that they're going to be in there for decades. So this momentary blip, I shouldn't lead with emotion and be freaked out and just take all my money out of it and make a loss essentially. So we need to think about the long term and not to panic sell or to listen to your neighbor's advice when they don't fully understand the bigger picture and the scope of what's happening. Markets go up and they go down. They have done over the last few decades, okay? So as long as you leave your money in an index fund for a long period of time, over 10 years I would say, then you will ride the waves of highs and lows. The next tip is what to focus on by age. So there's a big difference right now if you're in your 20s versus if you're in your 60s and you're investing. I'll put timestamps down below if you're not in your 20s, right? If you're a little bit older and want to look at a different age. But if you're young, it's really important to understand the timelines of when you are in your 60s and how you should invest versus in your 20s. So in your 20s, it's all about growth. You've got time on your side, which is a massive advantage. And there'll be something called compound growth that will really help you out. Let's say you're 25, right? And if you invest even just £50 into something like an S&P 500, which is tracking the 500 top companies in America, okay? So let's say you just invest £50 per month at age 25 and invest it all the way up to your retirement of, let's say, 65 years of age. Even with just £50 invested every month, this is how much money you'd have when you're 65. Versus, let's say you're a little bit bored on investing, don't think it's important to you in your 20s and just don't want to do it. If you wait until you're 35 and invest that same amount, this is how much money you would have. It's almost 100 grand of a difference. So the main thing here is time. The younger you are, the better it is to start investing, even if it's a tiny sum like £50. We should try and aim to invest about 20% of our monthly income. That can be a bit of a stretch, especially if you live in an expensive city like London or New York, right? But if you try and invest about 15 to 20% of your monthly income, you will, honest to God, be a millionaire by the time you retire. It's best not to try and wait for the perfect moment and to try and time the market, because that's usually when people fail and that's usually when people lose money. It's very difficult to time the market, and even the best investors in the world will fail at it. So the best thing to do is to be consistent and to start at a young age if you can. And also, it's really important to only invest in things that you fully understand. For people in their 20s, it's also really important to not get caught up in the hype of things like cryptocurrency and anything that your peers are telling you. You should really try and understand it first before you invest in it. I personally don't invest in any cryptocurrency because I believe it's way too volatile. If you look at a chart of Bitcoin over the last few years versus S&P 500, it's way more up, down, up, down, up, down, okay? So you want something that is steady, that is actually tracking real companies rather than something that may or may not take off. Let's talk about if you're in your 30s and you're investing right now. You may be at a different stage of life. You may be looking to buy a home. You may want to start a family potentially, but you still want to invest. And what I would say to people in their 30s is, yes, of course, still invest for sure. But if you want to buy a house, it's really good to have that deposit money saved separately in a high yield savings account. So for example, if you need 30 grand to buy a home in your 30s, you don't want to have to take that 30 grand out of your investments, because that will slow down the compound interest and not make it grow as fast as it could do. So what you need to do there is have it in a separate high yield savings account over time, and then you can buy, of course, assets like a house. For every age group, it's important to diversify. So not just put all of your money into Tesla stocks, for example, because that can be a bit risky, right? I don't personally invest into individual stocks, but everyone is different. If your risk tolerance is different to mine, of course, look into it. But with index funds, they are diverse in terms of they look at multiple different companies and they track the progress of that. But also maybe it's important to look at geographically different regions. So maybe not just America, which is what S&P 500 looks at, right? The FTSE 500 or the FTSE 250 here in the UK also looks at UK based companies here. I personally haven't invested in FTSE because over the last period of time, it hasn't done particularly well, maybe about 2 or 3% depending on the time frame, right? But it's really important to look at and understand which global sectors that you want to invest in, and whatever you're comfortable in, to actually invest in that country's economy essentially. So let's talk to people who are in their 40s or just approaching their 40s. This is also a really good time to readjust. You may have just bought a house, you may also have a family, but you still obviously want to invest over time. But it's important to maybe readjust. So a rule of thumb, which is something that John Bogle created. John Bogle was the founder of Vanguard, okay? And he basically said, as a rule of thumb, is that we should have the percentage of bonds equal to our age, okay? So if you're age 40, you should have 40% of your investments in bonds. Now, bonds are way less volatile than stocks or index funds, okay? And it just means that you're more likely to get a consistent rate of return, a lower percentage rate of return, but it's a little less risky as you grow older. And this goes without saying that every age group should work towards their emergency fund, but particularly in your 30s and 40s, you should have a watertight emergency fund. And as a reminder, an emergency fund is 3 to 6 months of your living expenses. So for example, if you pay 2 grand on rent, if you pay £200 on bills, £200 on groceries, you have a car that's £300, all of that will add up to your needs category, okay? And if you have things like health insurance or any sort of home insurance, those are also needs. So that total sum is your 1 month's living expenses. So you multiply that by 3 months or 6 months, and that would be your emergency pot. I always strive to have 6 months in my high yield savings account because you never know what's going to happen, okay? Especially if you're living by yourself, or maybe it's just a couple, or even if you have dependents like kids, it's important to have money there accessible in a high yield savings account, not in your investments, okay? Because you need to take this out whenever you need it. If your car breaks down, if someone gets made redundant, it's important to have that extra money on the side there as basically a buffer and a safety net for yourself. When you're in your 50s, you need to shift more towards low risk investments. So low risk investments can of course be more bonds as a split of your investments. So if you're age 50, maybe 50% of your investments should go into bonds. Also, maybe you should start thinking about dividend stocks. So dividend stocks is something that pays you a percentage every month or every year, depending on the company. So let's say if a company gives 10% dividends, they will pay that into your account every month or every quarter or every year. Every company is different, but it just means that you have passive income there working for you in the background. And of course, when you're in your 50s, you should totally avoid any big trends or any big, have you heard of this new crypto thing? And to take your money out of safe things and pop it into something more volatile. You should totally restrain and refrain from doing that. And of course, if anyone's in their 50s right now, let me know down below, has this tariff change in Trump's presidency affected your current stocks, and are you nervous about it? Have you changed anything from going into more safer options like bonds, or just staying with your index fund of an S&P 500? Let me know down below, I'm really curious. So when you come into your 60s, this is the retirement part of your life, and you should focus on preserving your wealth. So of course, not splashing money on frivolous things and really expensive items if you cannot afford it. And of course, think about inflation. Things like tariff could cause inflation in that economy. We don't totally know yet because it's such early days, but it may mean that even in other countries that it may affect the prices. So for example, in the UK here, it may actually mean that certain companies, instead of exporting to the US, they may just keep a lot more products in Europe or in the UK, which actually means there may be even a bidding war or like cheaper products because there's so much in the market. In your 60s though, you should know something called the Trinity Study, which you should look into before you get to that age group. And essentially what the Trinity Trinity Study is that we could withdraw 3 to 4% of basically our investments and live off of that until our retirement age. So the more time you leave your money in an index fund or something that will grow it over time, the more likely it will of course grow with the compound interest over time, and then you can use that and take money out regularly to live off that as a retirement. But of course, a lot of people will have pensions as well, which I will cover in a totally different video, but I'm just talking about your own personal investments. So look into the Trinity Study if you haven't already. It's super interesting, and people who follow the FIRE movement, which is people who want to retire early essentially, they try and work off the Trinity Study to get to their FIRE number so that they could retire early and just live off their investments. But of course, as you get into your 60s, you should definitely have more bonds in your investments, or if you're okay with risk, you can definitely have more stocks, okay? It totally depends on the person. If you are more risk averse or not, it really depends on your lifestyle and how you want to live as well. The next tip is dollar cost averaging, and essentially what this is you automatically invest the same amount every single month. So for example, when I first got into investing, I invested £100 a month because that's all I could afford right at the time, but it really helped me out to start. And I set up a direct debit or an automatic payment to purchase S&P 500 stock of a value of £100 every month. Now, what this means with dollar cost averaging is that some months you will pay more for a stock and some months you might pay less, but overall you're putting in the same amount of money over time. And this of course is the great thing, because you're not trying to stress and try and time the market. Oh my god, it's really cheap, let me buy more. Oh my god, it's really expensive, let me not buy any. It's none of that. It's taking the stress and emotion out of it, making it automatic, and of course you're growing with compound interest over time because you're being consistent. And also it's really important to look at the cost of index funds. So for example, with Vanguard, you may have seen recently that for new investors they did increase the price, which I think was the wrong idea. They shouldn't have done that for sure. But as your investments grow with Vanguard, the prices do drop. But if we pick any, broker for example, you have to ensure that the percentage is pretty low. So for example, for myself, I pay 0.07% for my index fund, right? So the more costs that they put on top of it, it means the less investments you'll have. So anything ultra low cost in terms of index funds is anything from 0.03% to 0.10%. Anything above 0.3%, you start to really lose out on the compound growth of your investment, and you're just basically giving more money to the broker. So try and find low cost index funds, and then you get to keep more of your money. Hello, free money. So my call to action for you guys is to let me know, if you're currently investing, what percentage cost do you actually pay at the minute? Are you in a low cost index fund, like maybe 0.03%, or are you paying maybe 1% on some brokers where they do charge that? And if you're totally new to investing and want to start, I did a video on how to do it from absolute scratch, which I'll pop in the description below. I tend to do a couple of videos a week, guys, essentially on financial well-being, how to invest and to manage your money better. So if that sounds like something you want to be better at and to have more money in your pocket, if you could subscribe, that would really help the channel out. I've done over 100 videos now and I'm very slowly creeping up subscribers. So if you want to be better with your money, let me know down below any video ideas that you have for the future and I'll happily help you guys out. But until then, I'll see you soon. Bye guys.